हेलो दोस्तों, बिजनेस पॉइंट में आपका स्वागत है। और अभी हम कर रहे हैं इकोनॉमी, जो है ट्वेल्थ की मैक्रो इकोनॉमिक्स। इससे पहले के नाइन्थ से लेकर ट्वेल्थ तक के सभी बुक्स कंप्लीट कर लिए हैं। इससे पहले कर लिया था, प्लेलिस्ट बना रखी है, नहीं देखी है तो देख लेना। इनकम मेथड, हैज़ वी मैंशनड इन द बिगनिंग, द सम ऑफ फाइनल एक्सपेंडिचर्स इन द इकोनॉमी मस्ट बी इक्वल to the incomes received by all the factors of production taken together. Final expenditure is the spending on final goods. It does not include spending on intermediate goods. This follows from the simple idea that the revenue earned by all the firms put together must be distributed among the factors of production as salaries, wages, profits, interest earnings, and rents. Let there be m number of households in the economy. Let Wi be the wages and salaries received by the ith household in a particular year. Similarly, Pi in Ri be the gross profits, interest payments and rents received by the ith household in a particular year. Therefore, GDP is given by GDP equal sigma mi equals to 1 Wi plus sigma mi equals to 1 Pi plus sigma mi equals to 1 INI plus sigma mi equals to 1 Ri equal W plus P plus IN plus R. Here sigma mi plus equal I equals 1 Wi equals W sigma I equals to 1 Pi equals to P sigma I equals to 1 Ni or In sigma I equals to 1 Ri equals to R. Taking equation 2.2, 2.4 or 2.5 together, we get GDP equals sigma Ni equals to 1 Ai equals to C plus I plus G plus X minus M equals to W plus P plus In plus R. Equation बन जाती है 2.6. It is to be noted that in identity 2.6, I stands for sum total of both planned and unplanned investment undertaken by the firms. Since the identities 2.2, 2.4 and 2.6 are different expression of the same variable, namely GDP, we may represent the equivalence by figure 2.2. Now let us look at a numerical example to see how all the three methods of estimating GDP give us the same answer. Example, there are two firms A and B. Suppose A uses no raw material and produce cotton worth 50 rupees. A sell it cotton to firm B, who uses it to produce cloth. B sells the cloth produced to consumers rupees 200. GDP in the phase of production or the value added method. Recall that value added equals to sales minus intermediate goods. VA equals to 50 minus 0 equals to 50. VAB equals to 20. 200 minus 50 equals to 150. GDP equals to VA plus VB equals to 200. Distribution of GDPs from firms A and B. Sales से 50, firm B 200, intermediates consumption 0, 50, value added 50 or 150. GDP in the phase of disposition or the expenditure method. Recall that GDP equals to sum of final expenditure or expenditures on goods and services for end use. In the above case, final expenditure is expenditure by consumers on clothes. Therefore, GDP equals to 200. GDP in the phase of distribution or income method. Let us look at the firms A and B again. Now, of this 50 received by A, the firm gives rupees 20 to the workers as wages and keeps the remaining 30 as its profits. Similarly, B gives 60 as wages and keeps 90 as profit. Distribution of factor incomes of firm A and B. Wages firm A 20, firm B 60, profits 30 and 90. Recall that GDP by income method equals to sum total of factor incomes, which is equal to total wages received worker of A and B and total profits earned by A and B, which is equal to 80 plus 20, 200. Factor cost, basic prices and market prices. In India, the most highlighted measure of national income has been the GDP at factor cost. The Central Statistics Office (CSO) of the Government of India has been reporting the GDP at factor cost and at market prices. In its revision in January 2015, the CSO replaced GDP at factor cost with the GVA at basic prices and the GDP at market prices, which is now called only GDP, is now the most highlighted measures. The idea of GVA has already been discussed. It is the value of total output produced in the economy less the value of intermediate consumption, the output which is used in production of output further, and not used in final consumption. Here we discuss the concept of basic prices. The distinction between factor cost, basic prices, and market prices is based on the distinction between the net production taxes, production taxes less production subsidies, and net product taxes less product subsidies. Production taxes and subsidies are paid or received in relation to production and are independent of the volume of production such as land revenues, stamp and registration fee. Product taxes and subsidies, on the other hand, are paid or received per unit or product, example excise tax, service tax, export and import duties, etc. Factor cost includes only the payment to factors of production. It does not include any tax. इसमें कोई भी tax include नहीं होता. In order to arrive at the market prices, we have to add to the factor cost the total indirect taxes less total subsidies. The basic prices lie in between. They include the production taxes, less production subsidies, but not product taxes, less product subsidies. Therefore, in order to arrive at market prices, we have to add product taxes, less product subsidies to the basic prices. As stated above, now the CSO releases GVA at basic prices, thus it includes the net production tax but not net product taxes. In order to arrive at the GDP at market price, we need to add net product taxes to GVA at basic prices. Thus, GVA at factor cost plus net production taxes is equal to GVA at basic prices. GVA at basic prices plus net production taxes equal to GVA at market prices. Table 2.5 at the end of the chapter gives the figure of GDP at market price and GVA at basic prices, while table 2.6 gives the composition of GDP from expenditure side. Some macroeconomic identities. Gross domestic product measures the aggregate production of final goods and service taking place within the domestic economy during a year, but the whole of it may not occur to the citizens of the country. For example, a citizen of India working in Saudi Arabia may be earning her wage and it will be included in the Saudi Arabian GDP, but legally speaking, she is an Indian. Is there a way to take into account the earnings made by Indians abroad or by the factors of production owned by Indians? When we try to this, in order to maintain symmetry, we must deduct the earnings of the foreigners who are working within our domestic economy or the payments to the factor of production owned by the foreigners. For example, the profits earned by the Korean-owned Hyundai car factory will have to be subtracted from the GDP of India. The macroeconomic variable which takes into account such additions and subtractions is known as gross national product (GNP). It is therefore defined as follows: GNP equals to GDP plus factor income earned by the domestic factors of production employed in the rest of the world minus factor income earned by the factors of production of the rest of the world employed in the domestic economy. Hence, GNP equals to GDP plus net factor income from abroad. Net factor income from abroad equals to factor income earned by the domestic factors of production employed in the rest of the world minus factor income earned by the factors of production of the rest of the world employed in the domestic economy. We have already noted that a part of the capital gets consumed during the year due to wear and tear. This wear and tear is called depreciation. Naturally, depreciation does not become part of anybody's income if we deduct depreciation from GNP. The measure of aggregate income that we obtained is called net national product, NNP. Thus, NNP equals to GNP minus depreciation. It is to be noted that all these variables are evaluated at market prices through the expression given above. We get the value of NNP evaluated at market prices, but market price includes indirect taxes. When indirect taxes are imposed on goods and services, their prices go up. Indirect taxes accrue to the government. We have to deduct them from NNP evaluated at market prices in order to calculate that part of an NP which actually occurs occurs to the factors of production. Similarly, there may be subsidies granted by the government on the prices of some commodities. In India, petrol is heavily taxed by the government, whereas cooking gas is subsidized. So we need to add subsidies to the NNP evaluated at market prices. The measure that we obtain by doing is called net national product at factor cost or national income. Thus, NNP at factor cost equals to national income. NI equals to NNP at market prices minus indirect tax minus subsidies equals to NNP at market prices minus net indirect taxes. Net indirect taxes equals to indirect taxes minus subsidies. We can further subdivide the national income into smaller categories. Let us try to find the expression for the part of NI which is received by households. We shall call this personal income PI first. Let us note that out of NI which is earned by the firms and government enterprises as part of profit is not distributed among the factors of production. This is called undisturbed प्रॉफिट्स यूपी. क्या बोलेंगे इसको? यूपी मतलब कि उत्तर प्रदेश नहीं, अनडिस्ट्रीब्यूटेड प्रॉफिट्स. We have to deduct UP from NI to arrive at PI since UP does not occur to the households. Similarly, corporate tax which is imposed on the earnings made by the firms will also have to deducted from the NI since it does not occur to the households. On the other hand, the household do receive interest payments from private firms or the government on the past loans advanced by them, and households may have to pay interests to the firms and the government as well in case they had borrowed money from either. So we have to deduct the net interest paid by the households to the firms and government. The households receive transfer payments from government and firms, pensions, scholarship, prize, for example, which have to be added to calculate the personal income of the household. Thus, personal income PI equals to NI minus undisturbed profits minus net interest payments made by households minus corporate tax plus transfer payments to the households from the government and firms. However, even PI is not the income over which the households have complete say. They have to pay tax from PI. If we deduct the personal tax payments, income tax for example, and non-tax payments such as fines from PI, we obtain what is known as the personal disposable income. Thus, personal disposable income PDI equals to PI minus personal tax payments minus non-tax payments. Personal disposable income is the part of the aggregate income which belongs to the households. They may decide to consume a part of it and save the rest. In figure 2.3, we present a diagrammatic representation of the relations between these measures macroeconomic variables. NFIA GDP GNP D NNP at market price ID minus subject NI NNP at FC UP plus NIH plus CT plus TRH PI PT plus NH PDI. Diagrammatic representation of the subcategories of aggregate income. NFIA net factor income for from abroad, बाहर से कितनी इनकम आती है. डी डेप्रिसिएशन. आईडी इनडायरेक्ट टैक्स. सब सब्सिडीज. यूपी अनडिस्ट्रीब्यूटेड profits. NIH net interest payments by household. CT corporate taxes. TRH transfers received by households. PTP personal tax payments. NP non-tax payments. National disposable income and private income. Apart from these categories of aggregate macroeconomics variables in India, a few other aggregate income categories are also used in national income accounting. National disposable income equals to net national product at market price plus other current transfers from the rest of the world. The idea behind national disposable income is that it gives an idea of what is the maximum amount of goods and services the domestic economy has at its disposal. Current transfers from the rest of the world include items such as gifts, aids, and etc. Private income, factor income from net domestic product occurring to the private sector plus national debt in interest, net factor income from abroad, current transfers from government, other net transfers from the rest of the world. बेसिक नेशनल इनकम एग्रीगेट, ये सारे नेशनल वो हैं बेसिक. और इसको अब करेंगे हम